You ever notice this strange thing in the markets? Gold, the so-called safe haven, drops in price when the dollar is rising. And not just a little, it can feel like a punch to the gut if you're holding gold, thinking it's invincible. But here's the thing most people miss. This relationship is not random. In fact, it's one of the clearest signals about how money and markets actually move. Today on Macro Rewind, we're going to break down exactly why gold falls when the dollar rises. And trust me, once you understand this, the way you see the markets will change forever. Before we dive in, do me a quick favor, hit that like button and subscribe to Macro Rewind. We bring you the simplest explanations for the most confusing market moves. If you stick around till the end, I promise, you'll understand not just the what, but the why and. That's where the real power lies. So why does this happen? Let's start with a simple fact. Gold is priced in dollars. Every ounce, every gram, every piece you see in the market has its value expressed in the greenback. That means, all else equal, if the dollar strengthens, gold becomes more expensive in other currencies. And here's the kicker. When gold is more expensive for people using other currencies, demand tends to drop. And when demand drops, the price of gold falls. That's the basic push-pull at work. But there's more to it than just currency math. The dollar's strength usually signals something about the global economy. When the dollar rises, it often means investors are moving towards safety in U.S. assets, especially U.S. Treasuries. And remember, gold is also a safe haven. So when money floods into Treasuries for safety, gold suddenly looks less appealing. Investors are essentially choosing one form of safety over another. This tug-of-war between dollars and gold creates a seesaw effect that can be subtle or sometimes very dramatic. Now, let's make this even more visual. Imagine you're in a crowded marketplace. Everyone has a certain amount of cash, and gold is one of the goods on sale. If your cash suddenly doubles in value overnight, the gold suddenly feels more expensive to you, even if the seller hasn't changed the price. Naturally, you might hold back on buying. This is exactly what happens on a global scale with currencies and commodities. The stronger the dollar, the less buying power there is for gold buyers outside the U.S., and the price adjusts accordingly. At this point, you might be wondering, is it always this simple? Well, not exactly. There are exceptions. For instance, during periods of extreme uncertainty, think wars, financial crises, or sudden shocks, gold can rise even if the dollar is strong. That's because fear can override the currency effect. Investors will buy gold no matter what the dollar is doing because they just want a tangible, reliable store of value. But outside those rare events, the dollar-gold relationship is remarkably consistent. Let's talk about interest rates for a second because this is where most people really get lost. The Federal Reserve, the U.S. central bank, sets interest rates that influence the dollar. When rates go up, the dollar usually strengthens because investors can get better returns on dollar-denominated assets. Higher rates also make non-yielding assets like gold less attractive. Why hold gold when you could earn interest on cash or bonds? The result? Gold prices dip when interest rates rise, and the dollar climbs. It's not magic, it's just the math of opportunity cost. Here's another layer that adds some spice to the story. Gold is often bought as insurance against inflation. But if the dollar is rising because the economy is doing well and inflation is under control, that insurance suddenly feels unnecessary. People aren't rushing to buy gold if they believe the dollar is strong and stable. Conversely, if the dollar is falling, fear of inflation or currency devaluation makes gold much more attractive. This explains why gold often acts as a counterweight to the dollar over time. It's the market's natural hedge mechanism. Don't get me wrong, gold can rise even when the dollar is strong, but that usually happens when something dramatic hits confidence in the broader financial system. Think of events like the 2008 financial crisis. Even though the dollar spiked in certain moments, gold surged because people were desperate for a real store of value. Outside of crises, though, the normal rule applies. Dollar up, gold down, dollar down, gold up. It's a simple relationship, but it's one most people overlook because they're chasing headlines instead of patterns. One of the coolest ways to see this in action is to look at a chart of the dollar index versus gold over the past 20 years. You'll notice a clear inverse pattern. Peaks in the dollar often line up with dips in gold and vice versa. There are short-term fluctuations, sure, but the long-term trend is unmistakable. Macro Rewind fans, This is exactly the kind of insight that can help you anticipate moves before they make the news. Understanding these patterns isn't about getting rich overnight. It's about seeing the forces at work so you can make smarter decisions. Let's pause for a moment and talk psychology. The human factor in markets is huge. Traders, investors, and even central banks are constantly making decisions based on perceived value, risk, and opportunity. When the dollar strengthens, people start thinking about returns in dollars, and that shifts behavior away from gold. It's almost Pavlovian: strong dollar, less gold buying. Weak dollar, more gold buying. Recognizing this psychological pattern can give you an edge because it explains why the market reacts even before fundamentals change. And this brings us to another subtle but important point: global trade. Gold is a global commodity, and the US dollar is the world's reserve currency. When the dollar rises, it impacts trade balances, foreign investment, and even geopolitical decisions. Countries that hold large dollar reserves see changes in their purchasing power, which in turn affects demand for gold. This is why watching the dollar can give you early signals about gold trends. Macro rewind viewers, it's like having a sneak peek into the market's next chapter. Now, I want to make one thing very clear. This isn't a perfect science. Nothing in markets ever is. There are times when geopolitical events, central bank policies, or unexpected crises can disrupt the usual relationship. But if you understand the core dynamics, the pricing in dollars, interest rates, opportunity cost, and investor psychology, you'll have a framework that lets you make sense of even the wildest swings. And that's exactly the kind of edge we aim to give you on Macro Rewind. Before we wrap up, let's tie this all together. When the dollar rises, gold tends to fall. Why? Because it becomes more expensive for the rest of the world. Opportunity cost increases. Treasuries look more attractive. And investor psychology shifts. When the dollar falls, gold rises because it becomes cheaper globally. Yields on alternative investments look less appealing, and fear or hedging instincts kick in. It's simple when you break it down, but so many people miss it because they focus only on short-term headlines or think gold moves independently. So next time you see the dollar climbing, don't panic if your gold holdings dip. And if you found this explanation helpful, make sure to comment below with your thoughts. Do you hold gold, trade it, or just watch from the sidelines? Share your experience and insights. I love seeing what the Macro Rewind community thinks. And of course, if you haven't yet, share this video with a friend who's confused about gold and the dollar. It might just help them see the market more clearly. Markets move fast, but understanding the why behind the moves gives you control. So keep watching, stay curious, and let Macro Rewind help you see the patterns that others miss. Because at the end of the day, knowledge is the best form of protection. Whether you're holding gold, dollars, or just keeping an eye on the story,